This is the S2G podcast, where we share conversations that help us understand how to scale the food, agriculture, oceans, and energy transitions. I'm your host, Tanya Bekritzis. Today, we're diving into how companies can use non-dilutive capital with Andrea Woodside and Marisa Sweeney from our Special Opportunities team. As a reminder, this content is for informational purposes only. It should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security, and is not directed at any investor or potential investor in any investment vehicle sponsored by S2G. Investing involves risk, including the risk of loss. Specific companies mentioned in this podcast are for educational purposes and should not be construed as an endorsement of any kind. Please note that S2G may maintain investments in some of the companies discussed on this podcast. For more important information, please see s2gventures.com/disclosures. Here's the good news. There are a lot of companies building innovative climate solutions. Over $150 billion has been invested in climate venture capital over the last decade. But many climate solutions require large-scale infrastructure or hardware manufacturing capabilities, which means the companies developing these technologies now face a pretty daunting obstacle: achieving scale. Actually, deploying these solutions can be very expensive. It takes substantial investment to build low-carbon maritime vessels or advanced recycling technologies, or to buy farmland or sustainable HVAC systems to lease. Many companies are at a critical stage where they have a viable product ready to deploy, but the typical funding options, such as VC or growth equity, might be too expensive or too risk-averse for their needs. S2G's Special Opportunities strategy is specifically designed to fill this critical gap in funding. The team takes a creative approach to capital by providing funding in the form of credit, project finance, or hybrid investment structures. Our Special Opportunities team also happens to be composed of some truly trailblazing women. It was a pleasure to sit down with S2G's Andrea Woodside and Marisa Sweeney to dive into why this strategy exists, what they have been up to over the past year, and the special opportunities they're excited about. Hi, Marisa and Andrea. Welcome to the S2G podcast. Super excited to have you here to talk about our Special Opportunities Fund. Unlike other funds, where you get a pretty good sense of what they do from their name, the Special Opportunities Fund is a little different and unique. So we'd love to dive into what your team does, the needs you're meeting in the market. But to get us started, I would love if you could introduce yourselves and tell us a little bit about your background and how you ended up here. So you want to start since you were first?
I'd love to. I'm Andrea Woodside. I joined S2G about 2.5 years ago to help launch the Special Opportunities Fund. It was our first kind of corporate equity product here. And given my background where I was investing across a lot of different private asset classes, I think that, fit this model quite well. So I joined from an impact investing group within Goldman called Imprint, where I was investing across mainly clean energy and food and ag private market sectors. So investing in credit, infrastructure, venture, and growth equity and buyout. And kind of grew up in and around impact investing, knew S2G for over a decade before joining here. So
here you are. Marisa, tell us about your background and how you got here. And also, I would love to hear the story of how you met.
Sure. I'm someone who, in college, I was really focused on trying to figure out what is my highest and best use. In my initial job out of college, I actually worked at Goldman Sachs as well. So Andrea and I share this kind of Goldman connection, which is kind of fun. It was a credit risk role. And two key things I learned in that role. One, if I'm going to be managing risk, I want to be paid for it. And I want to be on the investing side. And the second piece was just, and this is going to sound obvious to folks who are really familiar with finance, but I was really naive and I didn't realize you work a lot. And I just knew that if it wasn't important, if it wasn't morally significant to me, it just wasn't going to work because I would just get burned out. So I became very focused on trying to transition into a space that was impactful. And I was lucky enough to get my first job at a developer that was backed by Blackstone, and we were doing M&A of solar projects. I cut my teeth trying to figure out tax equity for solar portfolios. And then from there, transitioned to work at Generate Capital, which it's funny when you ask how Andrea and I met. I remember hearing Andrea give the Special Opportunities pitch at a panel that she did in San Francisco. And I was so excited because I was wow, that is exactly what I want to be doing, getting in that like $30 million range where very few folks are able to like finance and do things. And like that's where kind of like a lot of the magic happens.
Wow.
So
Amazing.
I was excited.
Well, we're so happy to have you. What is your perception of the meeting story?
I have a very specific memory of us grabbing coffee at the Ferry Building.
Yes.
And
Nice.
just like chit-chatting about personal and work stuff that just like our worlds were colliding. We both have some scars from the biological fertilizer space that we discussed and just generally discussed, life in the Bay. So yeah, we hit it off immediately.
It was meant to be.
Yeah.
I know one of the things we spoke about recently that you are both really proud of is just your team in general. Do you want to say a little bit about the team and why you're so proud of the team?
Yeah, I think we have an all-female team investing in credit and infrastructure, and I think that's pretty rare. But I think we're also very aware that, we could also use some more diversity on our team. And so interesting dynamic, but we really have a good thing going between currently 4 females on the credit and infrastructure fund. And then, of course, we are integrated into the broader S2G team, which I think I'm just super proud of the culture that S2G has built.
And I will say, being a woman working in finance, you're kind of a role model, whether you like it or not. And I think it's really empowering to be leading an all-female team on that. And I think in an industry where, you attend meetings and like 1 out of 5 times you are the only woman on the call, it's pretty impactful to show up with like, all right, this is our team of 4. It doesn't happen that often. People are often like, oh, okay. And I'm like, yes, this is our team.
This is it.
Yeah,
I love
totally.
it. Just to go off on a small tangent, I was an engineering major a million years ago, and it was a similar thing.
Yeah.
Right? Like it was one of hundreds that are in engineering. I know you do some things outside of S2G. Do you want to maybe give us a little summary of what you've been working on to sort of build that community?
Yeah. Once I made the strong pivot into solar, renewables, broadly speaking, like sustainable infrastructure, I became focused on trying to build my network outside of like my day-to-day job.
Yeah.
So I was able to get involved with young professionals in energy. I led the San Francisco chapter for a while. I also led CELI, Clean Energy Leadership Institute. I was part of their 2019 cohort and kind of did some, not in an official capacity, but helped organize.
Yeah.
And I got excited during the pandemic because I was like, I could actually take this skill set and port it over to start my own organization. And my co-founder and I, Megan Pasricha, we launched our organization, Women in Climate Investing in Finance, and we host events all around the country. And we're actually going to host an event in India in early January. I won't be there, unfortunately, but we're trying to reach women working in the space. And I think it's a bit of a call to action in a sense as well. Climate and decarbonization are huge, macro trends. There's going to be more and more climate professionals and certainly more women in the space. And we try to think of ourselves as one, kind of a mentoring organization for folks who've been in it, but also kind of a landing place for people who are realizing that this is impacting my role. So I think that's kind of how we think about it. It's a bit of the welcoming committee. Welcome to the climate effort. We're so happy you're here.
That's
let's
great.
Unite.
You guys have a great team. I'm so excited to work with you in some small way. Anywho, let's talk about work. Before we dig into special ops and exactly what you've been investing in and things, can you just start with a bit of an overview of the state of funding today? What trends are you seeing? And are there particular stages in which companies are struggling to finance their growth?
Yeah, I can start. So billions of dollars have flown into the climate tech and earlier stage clean tech space over the past decade plus at this point. And early on, a lot of that went to clean energy technologies, whether it was a new solar cell back in the early 2000s, and then later on a solar project. And that transition from early stage venture investing to then a lot of capital flowing into infrastructure, I think built a really nice base and model for what can be done across other sectors outside of renewables. And so today we're focused on basically helping companies that are at that kind of growth stage, transitioning from having a product and a service and starting to deploy it and helping make sure that they have the right capital sources to do that.
How much money do we need to get into the climate transition? Where are we at? And give us maybe some stats that frame it up.
Over $150 billion has been invested in climate tech venture capital over the last decade, and then trillions of dollars have been invested in climate infrastructure and asset-oriented investments. Now, I think that venture capital investment is really important because that has been invested in companies that are building brand new technologies, right? And there's a lot of technology risk there. And those investors are willing to kind of take big bets to hopefully have 10x investments in their portfolios. Now, once those technologies scale and technology risk is not, maybe scale up risk is there, but actual like engineering fundamental technology risk isn't there.
Yeah.
They then deserve a different type of capital and I think a different cost of capital. And so that's ultimately where we come in and pick, hopefully the best of the companies that have had some of that venture funding and then help them scale and deploy.
The way I think about it, and this was very much like a credit to our colleagues at Generate, like they would talk about it as like, we need like 50 Generates. And the way I think about it, particularly for our work on special opportunities, we are helping to catalyze the like hundreds of millions of dollars that need to go into one individual platform in order to scale and build out what they're trying to do. And I think of us as oftentimes not like a first of a kind type investor, specifically not that, but an investor that is helping to catalyze that more institutional, non-dilutive capital that helps scale pipelines and helps entrepreneurs show the proof of concept around bankability. A concept that you'll hear a lot in and around the space once you start digging in is this idea of a bridge to bankability, which is how do you show that technology concept A is going to be the next solar project, right? Like you have a very predictable asset. It can be operated by a myriad of players in the space, and the technology itself can be replaced by a myriad of players. So you're not reliant on any one like stakeholder in that project equation. And I think that as I think about what will really catalyze decarbonization and make the climate transition happen, it's more framing in that way and allowing us to advance the technology and business models to be more replicable and kind of plug and play in that sense.
That is a great transition to maybe saying a bit more about what is a special opportunity and how does your funding really differ from a typical VC round?
I think of the Special Opportunities Fund, in short, as an asset-oriented investment vehicle. We are looking at credit and infrastructure-oriented investment opportunities. Unlike our kind of growth equity colleagues who are looking at upside most of the time. And of course, downside and all of the necessary underwriting to make a good investment, we're often focused on downside protection, which is just a very different investment model and a different view of a transaction. And so we like investment opportunities with cash flows, collateral, or contracts that ultimately give us confidence that there's going to be the cash flow pull through there at the end of the day. Now, that can show up in a lot of different ways. Something that, we often talk about is we invest in different structures and we invest across different themes, but we always have a focus on assets and making sure that that downside protection is there. And then dependent on the specific business opportunity, we tailor our capital solution to that business opportunity. And ultimately, that value and that kind of value that we can carve off for investors then allows us to give a company a lower cost of capital.
How should companies think about pairing this with venture or growth equity investment? How do these things work together?
It's a great question. So I think opportunities where we're working with entrepreneurs who have already gotten shored up on the corporate side, whether that's even a Series A, Series B, et cetera, I think of us as the capital that helps drive growth, particularly into assets. This idea that we now have to build out a $100, $200, $300 million pipeline over the next 3 to 5 years. We can often be the first stop as far as getting non-dilutive financing that helps drive that pipeline growth and allows them to do it in a way that is not using dilutive, expensive corporate equity that is frankly like not the appropriate instrument. And then relatedly, like you have bank financing sometimes available, but banks are incentivized in a slightly different way. They're trying to create truly productized capital, and that can mean that it's harder for them to have the type of flexibility that a company that's in the stage of business building that oftentimes many of our counterparts are. And we're able to actually meet them where they are and provide that tailored solution. So I think what's exciting about our role is that we're able to dig in and I think provide folks a very impactful flexibility that then allows them to prove out their pipeline and kind of migrate on to like those bigger facilities.
I would just add that our capital is often not a replacement for corporate equity. I think it helps reduce the amount of corporate equity a company needs, but like if a company is running low on runway, I don't think they're like, okay, I'm going to go to special ops, or we don't want to be used as just a kind of runway extension. Instead, we think about, hey, let's plug in here, and then your corporate equity plugs in a different place. And as you scale assets and deploy assets, you need corporate equity, and you need to be able to fund SG&A alongside that, hopefully just less than what you would need if you were doing it on your corporate equity. So I do think there is an interesting connection between the two.
Even before our special opportunities strategy, S2G was founded with the objective of deploying fit-for-purpose capital. One of the earliest investments that embodied this approach and helped spur the creation of the special opportunities strategy was the formation of Clear Frontier. Clear Frontier is a fund that purchases farmland across North America and partners with farmers to transition the land to organic. I asked Andrea to share a bit about that original investment and how it shaped the work she does today.
S2G has been doing fit-for-purpose capital forever, since it started 10 years ago. We've been doing it through corporate structures, through some debt structures historically, and then out of our Food and Ag Fund 2, I think the team made a really exciting investment in a company called Clear Frontier that really helped just spur this entire thought process for the Special Opportunities Fund. So the idea for Clear Frontier came from a couple different angles that our Food and Ag team had across the food and ag supply chain. They also had relationships within the corporate industry with big CPGs that were demanding more organic, domestically grown supply. And they saw this dynamic and they said, okay, there's something, quite interesting here, but no one in the market is doing this. And the thesis was all around helping transition conventional farmland in the U.S. to organic and sell that. Primarily grain was the commodity that was most needed. Sell that to corporates under long-term, medium-term contracts. And in order to spur this market, the S2G team at the time went out and started building a team, basically, and building Clear Frontier to become a fund manager that would ultimately buy conventional and sometimes organic farmland, improve it, create more organic supply, aggregate that, and ultimately sell it to CPGs that were looking for domestic supply. So as we see more market opportunity white spaces, I think we can, deploy more models like that, or potentially, through different structures, and ultimately bring in third-party capital to help scale those solutions. So it's not just us around the table.
Very exciting. You've made a number of investments, so you've been at this a while now. Can you talk a little bit about those, maybe some examples of companies you've invested in, and how that kind of ladders up to your thesis and the themes that you're excited about?
Yeah. We invest across food and ag, oceans, and clean energy in asset-oriented businesses, as I mentioned. And we have a couple different business models that we're particularly excited about, or we talk about it as clusters. The first one is distributed asset leasing. So this is any business that has a hardware as a service model with contracts or leases on the other side. We also like development and helping businesses kind of scale, new asset development. Again, we have a focus, though, I'd say, outside of kind of wind, solar moving forward to help other technologies scale. And then we talk a lot about the gray to green transition and ultimately helping businesses that might have dirty or, gray business models transition to cleaner, greener business models, and ultimately having those maybe gray cash flows as downside protection while we give them growth capital to scale. So those are a couple of kind of horizontals across our themes that we look at. In terms of examples of investments that we've made on the hardware as a service or kind of distributed asset side, we've invested in a company called Service First Financial, which is basically providing heat pumps and other home comfort equipment as a service to consumers. And so that business model requires Service First to ultimately buy a bunch of home comfort equipment and put it into a consumer's home. It's not a direct sale, so they're not getting that cost for the equipment up front, and instead they get it over time over a 10-year lease. Mm-hmm. And so we help them through an SPV or special purpose vehicle structure, purchase that equipment using our debt alongside some senior debt. And ultimately, we then are kind of first in line for those lease cash flows over the 10-year period. And that just helps reduce Service First cost of capital and the amount of equity that they need to raise at the corporate level. A
topic getting a lot of attention these days are FOCs, or first-of-a-kind projects. Folks are projects that essentially bridge a technology between the pilot stage and commercialization and prove a project can scale. Folks are crucial for many hardware technologies to reach commercialization, but they are also hard to finance. Climate-specific funds may not be able to write a large enough check. Generalist VCs may be hesitant to get involved without seeing real revenue, and banks don't want to commit to debt financing without proof of the technology at scale. As Marisa mentioned, the special ops strategy doesn't focus on folks, but I wanted to get her take on the issue.
Folks are getting a ton of attention. So folks, first-of-a-kind projects. And this is just the idea of the first major project that a company builds out, whether that's a new carbon sequestration project or a newer electrolyzer, et cetera, et cetera. And I think the way to think about it, I tend to think about things on a risk-reward continuum. And I think particularly as you're comparing project capital versus corporate capital, you can call it whatever you need to, but at the end of the day, it's just a question around what risks are you taking. And I think the challenge with folk is that folk projects are often have a lot of flavors that are in common with venture-style corporate risk. And the difference is just they require a lot more money. So where I think you see us incorporating some of these fundamentals into how we think about the world, part of the attractiveness of a distributed asset base is the fact that learning rates on distributed assets are much more easily incorporated than if your project costs $100 million, $200, $500 million to build. Because at the end of the day, particularly when you're scaling up a large industrial process, you are learning as you go, which doesn't mean that we can't do it and it's impossible, et cetera. But I do think that there are just natural things that get figured out in practice that even if you have the most airtight independent engineer, Black and Veatch, et cetera, helping you understand the risk of the project, you really won't know until you're doing it. Oftentimes folks are like, but how do I make it project financeable? And I think that that's really a question around risk. And it's a question around how do I separate out risk and make it more understood at each level of the project. So to me, the types of folk projects that will be successful are likely ones that are able to incentivize stakeholders. It's aligning incentives because, frankly, when it's a first of a kind, things are not necessarily going to work out as per your planned, which is not necessarily anyone's fault. But it is a higher risk intrinsically. And I think it's about aligning stakeholders to ensure success and defining success kind of beyond just the fundamentals of that individual project.
So while funding for folks is important to progress many climate solutions, the risk profile is not the right fit for the special opportunities strategy. But if you have a proven product or business model and are trying to drive pipeline growth, this would be the time to pay close attention. Let's say I'm a founder or company leader listening to this podcast, and I'm curious about non-dilutive funding for my company. How would I know if my company is a good fit for non-dilutive capital?
So I often think around how we as a special opportunities team incentivize origination efforts and ensure that we're talking with companies kind of early enough in their journey as far as how they're shaping their model, et cetera. So in general, I think that if you're building something that ultimately, whether that's requires a customer contract or has some sort of as a service type offering, those tend to be the type of opportunities that will make its way into our pipeline. Full stop. And that honestly covers a lot of B2B businesses and some even B2C. So if you are selling a product that is maybe something other than a direct cash sale, we probably are interested at the highest level. I think from an overall strategic planning point of view, it's sometimes useful to chat with folks like ourselves because we can tell you these are good ways to set up your customer offering so that it is more bankable and more financeable in the long term. And this is how you can kind of manage your customers to this being the type of things we want to see in the contract, whether that's term, renewal rights, the way that the revenue is structured, et cetera, 2 to 3 year period, eligible for our funding. But it does go back to a lot of the items that Andrea talked about earlier. Do you have cash flows? Do you have consistency? Do you have something that we as a team can parse out from the individual corporate entity and finance itself? It's kind of all about segregating that risk and creating that consistency of risk profile that makes it most appropriate for more of an asset-oriented structure. But again, I love to talk with early stage founders as they're thinking through this. And I think it is one of those things where you should be chatting with people before you think you need it, because even if you don't need it, it'll at a minimum be a very nerdy and fun conversation about structured finance. But in the long term, it might shape how you would think about a customer offering and frankly, like potentially catalyze your business in a different way.
Very interesting. Anything you would add, Andrea?
Yeah, I think Marisa's point about, speaking to companies and speaking to us early on is a really good point, because oftentimes we speak with companies and they're like, oh, yeah, I mean, we have a direct sales business model today. We might launch an as a service business, but we need to get a little bit further down the path before, speaking to you about that. And I think our transactions sometimes take years to come to fruition. And so the earlier you can be developing a relationship and learning from investors and companies, I think the better. We have one example in our pipeline now where a company was like, come back to us in a couple of years once we kind of launch the business and have kind of proof of concept. And it's a really good example of a distributed business model where we said, no, we're actually okay to be the first here and to help you launch this business, given kind of the risk profile of the technology seems strong, cash flows, customer base, and ultimately the distributed nature of the risk profile and pipeline seemed underwritable. And so it's an example where we were willing to lean in earlier. And I think that surprised the company.
If you're building something exciting and you think that long-term you'll have contracts, I think the punchline is we'd love to talk about it. And that conversation will be a little different than the one that you would typically have with a venture-style investor. And I mean, it's an opportunity for both of us to learn. So a lot of appetite for that.
Are there any other things companies should consider when thinking about this?
Yeah, we often talk about technology risk. And I think technology risk can be unpacked in a lot of different ways. People might say, oh, well, it's developed. We're using it at a pilot scale. So it hasn't been commercialized yet. So we feel comfortable in it. And I think there we might say, okay, even though there might not be engineering risk, there is scale-up risk. There could be the other way around where maybe they've done it at scale for certain customers, but there need to be tweaks. And so then there can be engineering risk. I'd say generally we're more keen and comfortable to take scale up risk. And a lot of that, again, has to do with our focus on distributed assets and the ability to have a kind of diversified portfolio. And then cash flow visibility. So this gets back to, it could be a cash flow flowing business today where we get comfortable with that as collateral ultimately at the end of the day. Or there can be contracts, which then give us comfort for pull through. Oftentimes they say, oh, well, our cash flow or our contracts might be with all these different companies and they might be very early stage companies that don't look like a traditional investment grade kind of off taker. And so that's another thing that we often look at. And it's really nice to have an anchor kind of investment grade off taker for some of these projects. And then we might be comfortable filling in with earlier stage credit risk around that. But it's another important characteristic.
Are there any regulatory considerations?
Generally, we look at a product and a technology on a commercial basis. And so, there's a lot going on around the IRA this year, tax credits, a lot of different government and kind of regional incentives. And I think at the end of the day, there's risk to those potentially going away, right? And so we want to make sure and underwrite that a technology has attractive unit economics without those incentives at the end of the day. And so they can play an important role, and they've played a super important role in as we think about, renewables and tax equity financing. I think we just think pretty acutely about the risk of that potentially going away, right? If we are putting and kind of spending a lot of dollars up front for infrastructure, we want to make sure that we have a really, really strong view on the cash flow profile moving forward.
If I was a founder or company looking to explore these non-dilutive tailored solutions, what advice would you give me around making sure it's a good fit or collaborating with the other investors on the cap table? How should I think about moving forward?
I have some thoughts on this. Well, the first thought is just in general, if you're building within the climate tech space as an entrepreneur, that is a fundamentally challenging space to build. I mean, we both live in and around the Bay Area, and I meet some SaaS, like software as a service founders. And sometimes when they're like walking me through what the scale up plan, et cetera, is, I'm like, wow, this seems way simpler than what climate tech entrepreneurs are trying to build. Because if you're a climate tech entrepreneur, you are trying to have like literal proof of does the thing work, like technology risk. And then if this is something that needs to be deployed into sites and projects, you need a whole development suite of expertise, which as solar developers can tell you, it is not all like rosy and fun and easy. And then like on a third level, you also need like a finance function that is able to capitalize all of this efficiently. And I think that as an early stage founder, you're trying to figure out, well, how do I balance these priorities? How do I make sure that I'm ensuring my company survives for the next like 6, 12, 18 months, and then also looking forward to the future to build something that is really exciting from a value perspective. And it's not easy. And my point of view is, one, like overall, like I'm just so impressed with the folks that we meet in the space. They're doing incredible work. But two, if you're trying to learn more, just have conversations and talk about these things more in like the abstract as it relates to like concepts that are financially driven, et cetera. Because I think sometimes folks hear project finance and they think that's a black box. It's not. It's really something that can be unpacked and understandable. But if you're in the trenches of trying to get your venture rounds done, it's understandable that this is not where your time is focused. And I think encouraging more of those early stage conversations just to even conceptually understand so that you can bake it into your business model over the long term is the best way to start. We have friends at Spring Lane who are doing really incredible work. They have a whole developer university programming function where they actually like bring companies in to learn about these later stage pieces of capital. And I think so much of it is just professionals in the space. Like we want pipeline. We want entrepreneurs who are thinking about this and are ultimately building businesses that graduate into this type of capital. So the earlier, the better. And I think that you're hard pressed to find a project finance person who doesn't want to talk your ear off about SPVs. So, hit them up.
There's a lot of literature coming out around how to apply project finance structures to other climate tech industries. Creo is doing a lot of work here. They're a good partner of ours. And then the other thing that I would add is just for companies not to underestimate a strategic finance resource, I think can be really important for developer business models. And oftentimes, the CEO is running the business and has a lot of other things to do on a day-to-day basis. And the CFO, is also probably in a different mindset than a strategic finance person who's actually trying to fit all of the pieces together. And I wouldn't underestimate that role if you're trying to raise project finance.
We talked a lot about a couple examples in the portfolio or you're excited about, but is there anything else you'd like to share that you're excited about going forward?
I think I'm just excited about the overall opportunity. When I think about the potential areas that we can invest in, the white space that will come to bear fruit over the next 5-10 years. I'm so grateful just to be on this team and be in this seat where we're able to work to provide catalytic and impactful capital, which is not concessionary, right? Like this is capital that's going to return well. And I think the more I meet people, the more I see the folks that are moving into the space, I am just so like jazzed up about what that's going to look like over the rest of my career. Oftentimes entrepreneurs, they're the true experts in the space and we get to interact with them all the time. So that's
amazing.
Great.
Any last things you're excited about or grateful for before we wrap, Andrea?
I'm really excited about hopefully getting some more food and ag portfolio companies into the special ops portfolio. We talked about Clear Frontier earlier. I think it's a really exceptional example of our model, but other than that, we haven't made a food and ag investment yet. And given S2G's roots in food and ag and expertise and relationships across that value chain, I think I'm really excited to kind of lean into that industry and just excited to continue to grow the team and continue to deploy capital into exciting, life-changing businesses.
Amazing. Thank you guys so much for joining.
Thank you, Tanya. This was fabulous.
It was very fun.
Thank you.
I enjoyed the time. Andrea and Marisa could not emphasize it enough. If you think your company might be a good fit for this kind of capital, reach out. It could lead to an investment or advice on how to make your business model a better fit for non-dilutive capital in the future. Or it could just be a nerdy finance conversation. There's a lot to learn and nothing to lose, so we look forward to hearing from you. Thank you for tuning in to the S2G podcast. If you enjoyed this episode, please subscribe, leave us a review, or share it with a friend. For more information or to connect with us, check out s2gventures.com.